Budgeting is an integral pillar of financial planning and control in any organization. It provides a quantitative expression of planned activities, serving as a guide for executing organizational objectives. In this module, you will gain a comprehensive understanding of budgetary systems, types of budgets, and budgeting techniques. Emphasis is placed on the strategic role budgeting plays in aligning resources with goals, facilitating performance measurement, enhancing accountability, and supporting managerial decision making. This module also examines the behavioral implications of budgeting, common challenges, and modern budgeting approaches such as zero based budgeting, ZBB, rolling budgets, activity based budgeting, ABB, and performance based budgeting, PBB. By the end of this module, you will be able to understand the purpose and functions of budgeting in cost control and planning, differentiate between various types of budgets, prepare functional and master budgets, apply modern budgeting techniques such as ZBB, ABB, and rolling budgets, identify the behavioral implications of budgeting systems, analyze the role of budgeting in performance evaluation and strategic planning. Introduction to budgeting. A budget is a financial and/or quantitative statement prepared and approved prior to a defined period of time for the purpose of attaining a given objective. Key characteristics of budgeting. 1. Forward-looking. 2. Quantifies operational plans. 3. Aids in coordination and control. 4. Enhances financial discipline and accountability. And 5. Facilitates planning and resource allocation. The budgeting process includes setting objectives, identifying limiting factors, communicating and coordinating, preparing functional budgets, consolidating the master budget, monitoring and reviewing performance. Functions of budgeting. Planning provides a roadmap for resource allocation. Control compares actual versus planned performance. Coordination ensures all departments work toward a common goal. Motivation encourages goal setting and performance. Communication provides a structured way of sharing operational goals. Evaluation forms the basis of performance appraisal. Types of budgets. A. Based on time. Short-term budgets, up to 1 year. Long-term budgets, over a year, strategic in nature. Rolling, continuous. Budgets, updated regularly, e.g. monthly or quarterly. Based on function. Operating budgets, sales, production, purchase, labor, overheads. Capital budgets, long-term investment and capital expenditure planning. Cash budgets, forecasts of inflows and outflows to manage liquidity. Master budget, consolidated budget combining all functional budgets into an integrated plan. C. Based on flexibility. Fixed budgets, prepared for a single level of activity, not altered once finalized. Flexible budgets, adjusted for different levels of activity, useful for dynamic environments. Modern budgeting techniques. A. Zero-based budgeting, ZBB. Every item must be justified from scratch. No automatic approval of past expenses. Promotes cost efficiency and rational spending. Encourages questioning of organizational assumptions. Time-consuming and resource-intensive. Best for government agencies, nonprofits, cost-sensitive firms. B. Activity-based budgeting, ABB. Aligns budgeting with activities that drive costs. Based on forecasted activity levels, not just past trends. Closely linked with activity-based costing, ABC. Improves cost visibility and control. Emphasizes cost drivers over historical spending. C. Performance-based budgeting, PBB. Links funds to measurable outcomes or performance targets. Encourages results-oriented management. Useful in public administration and nonprofit budgeting. Focuses on efficiency and effectiveness. D. Rolling budgets, continuous budgets. Constantly updated by adding a new budget period as the most recent one expires. Keeps management focused on the future. Reduces the disconnect between planning and execution. The master budget. The master budget is the comprehensive financial plan for the entire organization. It integrates, period. Sales budget, production budget, direct materials budget, direct labor budget, overhead budget, selling and admin budget, cash budget, budgeted income statement, and balance sheet. This serves as a central control document, aligning operational and financial targets. Behavioral and organizational impacts. Budgeting is not purely a financial tool, it has behavioral implications. Can motivate or demotivate staff depending on fairness and attainability. May create budgetary slack, underestimating revenue or overestimating costs. Promotes goal congruence if participative budgeting is used, and helps in responsibility accounting and performance accountability. Limitations and criticisms of traditional budgeting. Time-consuming and rigid. Can promote short-term thinking. May discourage innovation. Often politically influenced and prone to manipulation. And modern organizations often complement it with agile planning tools. Practical tasks for you. Prepare a flexible budget for a manufacturing firm at varying activity levels. Compare traditional budgeting with ABB for a service organization. Develop a performance-based budget for a government department. Identify cost drivers for a rolling budget in a logistics company. Prepare a master budget for a small enterprise.